FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
This episode of the Financial Survival Network is brought to you in part by Sandstorm Gold Royalties. Sandstorm Gold Royalties is a different kind of gold company. They purchase royalties on select mining operations and receive a percentage of the revenue in return. Sandstorm now has a portfolio of over 185 gold royalties around the world. See how gold royalties differ from other gold mining investments at sandstormgold.com. That's sandstormgold.com. Sandstorm Gold Royalties trades on the TSX as SSL and on the New York Stock Exchange American as SAND.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and it's President's Day. That's 2/18/19. Well, hey, markets are closed. Maybe that's a good thing. Well, the markets have been recovering quite nicely. And in the meantime, the COMEX is closed. But in earlier trading, gold was up a good $4 plus per ounce to almost 13.26, and silver up a little bit into the 1570s. Anyways, you know what that's about. Let's see what the new tax law has done, what crazy results it has wrought upon us. You know, the old saying that a camel is a horse created by a committee. Well, the new tax law certainly has a lot of attributes of a camel. The humps are all over the place. I don't know how you sit on the thing because the humps are just in your way. In any event, let's find out about what insanity it has wrought upon America. And with us is Elizabeth Hale, CPA, tax expert. And Elizabeth, we welcome you to the show. So we're looking at all of these unintended consequences of the new tax law. What is your favorite?
My favorite is that actually the middle class or the wage earners that, you know, we might have both spouses working, those with children, those people are hardest hit by the tax savings, so to speak, because they're used to being able to potentially write off additional deductions like the state income taxes, the unreimbursed employee business expenses, and things like that. And this year, that's gone in favor of a larger standard deduction. However, for parents, you know, a middle income with both people earning wages and having 2 children, they're actually getting a bit penalized, especially if they're in high income tax states like New York and California, because they're not able to deduct all of their taxes the way they were able to before. And even with the increased deduction for standard deduction, it's not covering what they used to be able to deduct between that and the exemptions that they used to take. Mm-hmm. So right in February last year, 2018, the government went through and adjusted all the payroll tax withholding tables. So if you are employed, not self-employed, then your taxes were reduced a little bit out of each paycheck, which you might not have noticed, but now come time to file, you might find out that you owe or that your refund is greatly reduced.
Mm-hmm. So you might be getting a little bit more money. Obviously, the so-called working rich, they're really the ones living in these high-tax states, have really taken it on the chin, haven't they?
Yes. So most definitely. Now, there are some great benefits to owning your own business. So for entrepreneurs, on the flip side, if you have a business that's generating income and you're not a specified service business, like an accountant or an attorney or a medical practice, then you are allowed to take up to 20% deduction for your profits without paying tax on that. So that has been a big boon on the flip side for entrepreneurs and business owners.
Hmm. Interesting. So business owners, somewhat, but a lot of people. So, what are the limitations as far as being a business owner and being able to get that 20% deduction?
So in order to qualify for that, you have to have an operating business. So that's making a profit to take advantage of the qualified business income deduction is what it's called. QBID is how it's referred to often. The qualified business income deduction allows you a deduction or to basically shelter 20% of your profit against tax. So you will not pay tax on 20% of your net profit. Now, if you are in one of the professions like accounting or law, if you're married filing jointly and your income is below 400,000, then you will not have. You will be below 315 is the threshold. 315,000. Then you can still take the 20%, but the income phases out between 315 and 415,000. And once you've gone past that, you don't qualify for the qualified business income deduction. Mm-hmm. So there are some strategies that you could employ to keep your income below the threshold if you are in a professional services business. You know, you can get more elaborate retirement plans in place, set up some different entity structures to split off your business and some more esoteric strategies. But all in all, you know, that's pretty much the game in business today is to try to take as much advantage as possible of the qualified business income deduction.
So there's winners in this thing, there's losers. If you were an attorney, say in New York City, it would make a lot, and you were working for a firm, you're an employee, wouldn't it make a lot of sense to go start your own law firm and, basically convert as much income as you can to self-employment income?
It would, but there's a lot entailed to starting your own practice, of course, if you're used to relying on other people to bring in the work. And, there's a whole other... there's a different skill set when you're trying to build up your own business than there is to show up and kind of punch in and collect the paycheck.
Yeah, well, if I was a lawyer, I would go to my firm and say, look, you're paying me with all benefits and everything. You're paying me $500,000 a year. All right, I'll do it for $400,000, but I'm going to be in my own law firm. I'll guarantee you X amount of work per week, X amount of hours, and presto, a lot of firms would take that offer, wouldn't they?
Yeah, there would be quite a few, unless they were concerned about like non-compete or whatever.
Yeah.
Then yeah.
Yeah, so there are ways around it, and also it doesn't pay to be a homeowner anymore in these high tax states, does it?
No, because if your taxes are maxed out at, that includes your property taxes. So for example, just an average home in New York State is generally can range anywhere from 10 to 20,000 plus in taxes. And that's not a mansion. That's just property, school and property taxes. So right there, you're over the threshold. That doesn't even account for your income taxes. So the real estate taxes alone, the limitation on being able to deduct those combined with a lot of mortgage interest if you're, towards the end of paying off your loan, or now you're capped on the mortgage interest of only being able to deduct the first interest on the first $750,000 of loan amount. So which is down from $1 million. Before you could have $1 million mortgage and be able to deduct that plus another $100,000 in home equity loans. But now, you're very limited as to the ability to deduct the interest as well as the ability to deduct the property taxes.
Yeah, so you've gotten hit on that. You can't deduct your home equity line of credit, but I think you can deduct the second mortgage up to a certain point. Is that correct?
Yeah, as long as your two mortgages do not equal more than $750,000, unless you had the mortgage prior to the law change in December 2017.
Right. So it's hitting the upper middle class. Basically, the upper middle class is paying for the tax cut for businesses and for lower income individuals. the wealthy, yeah, they're paying it, but they have ways around it, I guess. It kind of makes you want to turn your house into an Airbnb, right?
You can, sure. You definitely rent out some space there to make up some extra money.
Yeah.
Pay your tax.
And the other thing is, I believe you're in Arizona. I'm in Florida. You're a lower state income tax state. We are income tax free. So what we're seeing is literally people rushing for the doors, voting with their feet. Anybody that can get out of these high tax states, California, New York, New Jersey, Connecticut, Massachusetts, Taxachusetts, Rhode Island, all of these states, they're just getting the heck out of there as fast as they can. So Is it kind of like warfare here? Maybe the Civil War isn't over. Most of these high-tax states are in the north. Most of the low-tax states, though not all, are in the south. So maybe there's something to it. Maybe this is the second Civil War taking place on your income tax form.
Perhaps it could be. I know that the warmer states are getting a huge amount of population growth as well. So maybe it's, most of out here in the Southwest, there's still a lot of brand new population growth and brand new housing and building. And it seems like some of these states can live on quite a bit less. Although, we're not ranked very highly for education here in Arizona, but we have a great university that's been getting some better press.
Yeah, well, education is overrated anyway. Certainly, in many respects, when you go to college and go $100,000 into debt and get a degree in puppetry, and nobody's going to hire you for some reason, education for the sake of education, not quite what it used to be, for sure. So, what about some other things hidden in this tax bill that aren't really well known?
That aren't well known. Well, a lot of people they're still confused about the whole Obamacare and whether the Affordable Care Act, and the IRS has indicated that they are still charging penalties through 2019, through 2018 tax returns. So a lot of people weren't aware, but with all the growth in global economy, you can, by electing to be taxed as a C Corp, if you do own a business, then you can save substantially, potentially, depending on the type of business that you have. The corporate tax rate dropped to a flat tax of 21%. But if you export goods or software, we have quite a few clients that make very niche software. If you export that to another country, you can actually potentially get your tax to 5%. So that is a huge savings for anyone that is exporting anything. So what they're trying to drive is obviously the U.S. exports versus the U.S. imports. So that is not very well known. There's also something called opportunity zones. So if you did cash in your stock portfolio because went crazy this fall, and you have some gains, you do have an opportunity for within 6 months making a sale of either stock, real estate, a business, anything that yields a capital gain, whether it's short-term or long-term, and you have an option to reinvest those proceeds in opportunity zones. So opportunity zones are designated plots of land in every single state that they have designated to with making private investment. So if you make private investment, you don't pay tax on the gains that you had if you reinvest in a qualified opportunity zone fund.
Mm-hmm. Are people actually doing that? Or are they out there investing in opportunity funds?
Yes. There's quite a bit of interest and quite a bit of motivation right now in the Arizona community. I've had clients working on projects in Florida as well, and Georgia. Some of these opportunity zones that were designated are very surprising. There's quite a bit of land here in Scottsdale that's designated as opportunity zone area. And it's to revitalize those neighborhoods so you can invest in real estate or in new businesses that are producing new employment in those areas. So it can be very lucrative.
Oh, okay.
Plus, you're deferring your tax.
Yeah. So the government giveth with one hand and they take away with the other, huh?
Yeah. Yeah.
Mm-hmm. So has the tax bill been good for your business?
Yes. We've done quite a bit of work in the opportunity zones area and just a lot of education and, a lot of strategy and planning to take it maximum and that are available. We mainly work with business clients and the owners of those businesses, so or higher income wage earners. But typically, we only work with businesses, so we focus on all the aspects because the individual, if you get a W-2, if you max out your retirement plans and your HSAs, and there are some other types of charitable types of employee, but other than that, you're kind of locked in to what you're scheduled to pay.
Yeah, so it's a good time not to be an employee. If you're going to go into business for yourself, the government has really given you some huge incentives to do so. And in addition to the old incentives, you got more incentives because of the deduction for, the 20% deduction, right, for the flow-through entities.
Yeah.
And so many other benefits you get from being in business for yourself, of course. Hey, people want to find out more about you and more about what you're doing. Where do they find you?
Either on LinkedIn at Elizabeth Hale, CPA, or on our website, eecpa.com.
All right. And we'll have a link to eecpa.com in the show notes of this interview. Well, that's a lot to chew on. A lot of things happened in that tax plan that really weren't well thought out, but a lot of them are indeed were deliberate and well thought out, and that's what we're dealing with now, the aftermath of it for sure. Anyway, Elizabeth, thanks so much for coming on. Hey, questions, comments? You got a tax issue that you would like, hypothetical tax issue that you'd like to get some info on, then just email us, kl@kerrylutz.com. Of course, we can't give you financial advice. We're not licensed in anything other than real estate. And hey, email address, kl@kerrylutz.com. And if you are listening to the podcast through regular channels, or if you're watching it on YouTube, then please subscribe, like, and share. It really helps the show, helps me a lot when you do it, gets the information out there. That's what it's all about. Elizabeth, thank you so much for coming on. A pleasure.
Thank you, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.